Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Capital Group American Balanced Fund LUX. This video is done as a follow-up request from a viewer's comment in my previous video covering the Signature CIO Income Fund from Standard Chartered. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Capital Group is a US-based asset manager founded in 1931 by Jonathan Bell Lovelace. The firm started managing their first fund in 1934, which is still running strong today. Capital Group is privately owned by 450 partners as per Wikipedia and currently manages over 2.8 trillion US dollars of assets, focusing on actively managed fund solutions. The firm has 363 portfolio managers and analysts, and the average portfolio manager tenure is 21 years. So this is a pretty large team of well-experienced investment professionals. Capital Group has a unique capital system established since 1958 that essentially split all their investment portfolios like a pie and have each piece run by an individual manager or analyst. The person responsible for the piece of the pie is also typically invested in the portfolio, so there is alignment of interest to ensure success. Capital Group is also one of the less common asset managers that allows research analysts to be on par with managers and be directly responsible for a piece of the pie. This approach was aimed to eliminate the star manager key man risk and also to diversify views, which has proven successful for Capital Group through the years. The Capital Group American Balanced Fund LUX is a sub-fund under the Capital International Fund or CIF fund family. CIF is set up as a Luxembourg SICAV company structure and is UCITS qualified. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The original Capital Group American Balanced Fund is a US onshore fund launched in 1975 and is one of the largest and oldest US multi-asset fund strategy. The fund covered in this video is the offshore version of this original fund. Given this fund falls under the Luxembourg SICAV setup, there is the LUX added to the fund name to differentiate it from the original fund. As before mentioned, Capital Group uses a multi-manager system for all its funds. For the American Balanced Fund, there are a total of 12 portfolio managers, as well as an unknown number of research analysts, each covering a different segment of the market. The web page of the original US vehicle gives a nice graphical summary of the experiences of each manager. I'm not sure why Capital Group doesn't put this in the offshore fund webpage. Here, we can see that these managers have at least 19 years of industry experience, with Hilda and Alan Barrow having the longest tenure managing this fund strategy for 25 and 19 years respectively. The long tenure of most of these managers working in Capital Group also suggests that they are happy working in the firm and there is low turnover. The Capital Group American Balanced Fund LUX states in its fact sheet an investment objective that seeks the balanced accomplishment of capital conservation, current income generation, and long-term growth of both capital and income. The word balance suggests the three objectives are equally important, although we know that we cannot have the best of everything, so something has to be sacrificed. In this case, if the fund is trying to achieve a balanced outcome of all these objectives, the likelihood would be that it might do okay for all of them, but nothing awesome for any of them. In essence, this is like a jack-of-all-trades, master-of-none type of investment objective. The fund webpage provides a slightly longer investment objective that includes a mention of investing in mainly stocks and investment-grade bonds domiciled in the US. The mention of investment-grade bonds suggests that the fund may not be too adventurous in high-yield exposures. The fund also has a benchmark defined that is 60% S&P 500 index plus 40% Bloomberg US Aggregate Total Return Index. This gives us a guideline that the fund is likely to have roughly a 60% US equities plus 40% US bonds asset allocation in the long run. Let's find out more details in the prospectus. The prospectus starts off with the same investment objective paragraph. This follows by further clarification on the asset allocation limits that states a minimum of 50% in equities and 25% in bonds. This means the allowable range would be from 50% equities plus 50% bonds to 75% equities plus 25% bonds. This provides some flexibility for the fund to navigate through market up and downs. And the benchmark of 60% equities plus 40% bonds still makes enough relevance for performance comparisons. We can also see here it is quite clear the fund aims to mainly have investment-grade bonds in the portfolio. The prospectus goes on to provide more specific investment limits, such as maximum 20% in securitized assets and maximum 5% in total return swaps. The fund can use a wide range of derivatives for investment purposes, though there are no details provided by the fund for actual implementation, so we won't really know what the fund uses. The fund also has the flexibility to allocate maximum 20% to non-US domiciled investments, which gives the fund some leeway to diversify outside of US in the event if there is a US-focused market crisis. There is an additional limit of 5% in emerging markets, 5% in China onshore equities, and 5% in China onshore bonds. Lastly, the fund can also have up to 15% securities lending, though the prospectus states this is expected to be generally less than 5%, so this is not really of concern. That's all there is in the prospectus, however, so there really isn't any explanation on how the investment process of the fund works. I then chanced upon what seems to be a fun feature webpage that gives a bit more marketing color. Strangely, I found this from Googling as I can't figure out how to access this page from Capital Group's own navigations in its website. Here, it suggests the fund strategy primarily uses the equity allocation to get market upside and the bond allocation to help preserve capital and reduce downside losses. There is also an emphasis that the fund focuses more on high-quality exposures on both the equities and bonds selection, with a long-term investment horizon view. As there is unfortunately no more fund strategy details I can find, let's move on to the actual fund portfolio. The Capital Group American Balanced Fund LUX was launched in 2021 and currently has nearly $800 million of assets. This is considered quite small relative to other competitor funds in the market, so there is definitely plenty of room to grow. One reason why Capital Group wanted to offer this fund is because the original US onshore fund is one of the largest US multi-asset fund in the market with over $240 billion of assets. So it is natural for the firm to want to try to replicate the success outside of US. There is actually not too much portfolio information provided by the fund. Here is the sector and geographic region breakdown from the fact sheet, which I like better for its more compact presentation compared to the same data in the webpage. Here, we can see the portfolio currently has 63% equities, 33% bonds, and 4% cash. This is not too different from the 60% equity, 40% bond benchmark allocation. Looking at equity sector breakdown and comparing against S&P 500 index, the fund appears to be underweight in IT and consumer discretionary, while overweight in industrials and consumer staples. There is a 1-month difference in the data timestamp though, so the fund may have made some adjustments in June that is not yet disclosed. This may also be partly attributed to the small exposures in Europe and emerging markets equities in the portfolio. The bond sector breakdown shows more differences comparing to the Bloomberg US Aggregate Bond Index using the SPDR ETF as a proxy. Here, we can see the fund has significantly less government bonds in exchange for a lot more securitized exposures, which would normally be mortgage-backed securities or MBS in this case. Corporate credits exposure in the fund also looks slightly higher. Geographic breakdown wise, there are small exposures in non-US regions, though nothing that looks alarming. The fund currently has about 450 holdings in the portfolio, which is normal for multi-asset funds, as these strategies typically hold a lot of individual bond issues. Capital Group does things slightly differently from other fund providers for the top 10 holdings, as it shows by bond issuers instead of bond issues. There is no right or wrong to this, though I think it would be useful if Capital Group can provide a full holdings download function for investors who want to review individual positions. The securitized assets exposure in MBS shows up prominently in the top 10 holdings. The uniform MBS is mainly issued by Fannie Mae and Freddie Mac as well, so they really all refer to the same issuer risk. There seems to be more mutual funds these days using agency MBS as a replacement for US Treasury exposures in their portfolios. With no further data available from the fund's webpage and documents, let's get some additional information from Morningstar. For the equities part, Morningstar indicates the fund is very much tilted towards mega cap stocks with no bias on value or growth. Average market cap is significantly higher than category peers. Financial measurements are more similar with peers, with the exception of higher sales growth, lower historical earnings, and lower cash flow growth. For the bonds part, the fund has a very high AA- average credit rating as a result of high allocations to government bonds and securitized assets. Yield to maturity is 5.03% and duration is around 6.5. The credit rating breakdown gives a clear picture of significant AA-rated exposures in government and securitized sectors. Corporate credits are a mix of single A and BBB rated. The overall yield to worst also looks generally quite high, with more than half of the bond exposures having 5 to 7% yield to worst and the rest around 3 to 5%. Overall, this looks like a high-quality portfolio with a strong bias towards mega-cap equity exposures and high credit-rated bonds to keep it relatively more stable. The equity part of the portfolio has no growth or value style bias. There seems to be active management at work given some sector differences versus S&P 500, plus a little bit of non-US tactical exposures. The bond part of the portfolio is designed to be risk-averse with no high-yield bonds. The heavy overweight to agency MBS is likely to try obtain higher yield than treasuries while keeping average credit rating high. The Capital Group American Balanced Fund LUX comes with a long list of share classes, but we'll focus on the B class, which is the normal class for retail investors. The fund initially only had accumulation for US dollar class at fund inception in 2021, suggesting the fund did not really position itself as an income solution. The fund then launched the FYD distributing share classes in 2022 and the FDX distributing share classes recently in 2025. I'll talk about the differences between the two in a while. All distributing share classes have monthly distribution frequency. There are both hedged and unhedged versions for non-US dollar currency classes. Besides Sing Dollar, other currency classes available include Aussie dollars, CNH, Euro, Sterling, and Hong Kong dollars. B share classes have a 1.3% management fee that is just revised down from 1.5% as of 1st July 2025. Adding other expenses gives a total expense ratio or TER of around 1.65% that should be reduced as well following the management fee revision. Up to 65% of the management fee can be paid by Capital Group to distributors as trailer fees. The fund allows distributors to charge up to 5.25% subscription fees, although I think anything more than 2% for mutual funds is excessive. Let's now find out what's the difference between the FYD and FDX classes. There is a detailed description available in the fund prospectus where we can see the FYD class is calculated based on fixed percentage on the NAV so that the annual distribution yield percentage is more predictable. There is a possibility that the payout distribution may exceed the net investment income, where then some capital will need to be used to cover for distribution. The newer FDX classes focus instead on paying out a fixed dollar value of distribution, So investors are getting a fixed value monthly, but the distribution yield percentage will fluctuate. There is a specific mention that these classes are meant for Asian clients, which typically imply that the distribution yields will likely be higher as there is more demand for higher yields from Asian investors. The distribution history is available in the fund webpage, so we can see clearly the differences when we put the data side by side. Here, we can see the BFYDM US dollar class has a slightly varying dollar value payout every month, while trying to maintain the distribution yield at around 0.42% per month, or around 5% per annum. The BFDXM USD share class, on the other hand, has a fixed dollar value payout every month, which results in a fluctuating distribution yield. The BFDXM class is new, so there are only two payout records. Though using the limited data, we can estimate this share class should have an annualized yield of around 6.7% to 7.0%. So going through the data of the different share classes gives us the result that the FYD class currently has a distribution yield of around 5% per annum, while the FDX classes is expected to yield around 6.7% to 7% per annum. As the yields look the same across currency classes, we can also deduce that the currency hedging cost is applied in the NAV instead of the distribution. Now, if we assume that Morningstar data is accurate, the fund has around 1.82% equity dividend yield and 5.03% bond yield to maturity. If we calculate based on a 60% equity, 40% bond allocation, that gives us around 3.1% natural income generated from the portfolio. Then what this means is that the FYD class need to take around 2% from capital to make up for the 5% distribution yield, while the FDX classes need to take around 4% from capital for the same purpose. Now this is simply a matter of taking out more or less amount from the same pool of investment capital. But do remember, a smaller capital pool means less growth on a long-term basis. The performance data of Capital Group American Balance Fund LUX is not available in the fund webpage but can be found in the fact sheet, which includes calendar year, various annualized time periods, and a cumulative returns chart. Given the fund was only launched in 2021, there isn't much data for us to look at. We can see, however, the fund had underperformed in 2023 and 2024, resulting in lower overall returns compared to the benchmark in 3-year and since inception periods. If we take reference from the original US onshore version of the American Balance Fund Class C, we can also see the fund had underperformed the benchmark slightly in past 3, 5, and 10 years. The fund, however, outperformed very slightly if we look at since inception period, which suggests it may be getting harder for such a strategy to find opportunities to deliver alpha returns in recent years compared to earlier decades. And this makes sense because we know that markets are definitely more efficient now than the past. With the very long track record of the US onshore version, we can also see that in the long run, an investor can probably expect to obtain around 8% to 10% per annum returns from this fund strategy. So as an investor, you can already have a sense whether this return expectation is good enough for yourself. This also means that there is at least enough returns gains to cover the current payout yields of the different share classes. One thing about running a 60-40 asset allocation strategy in the US market is that it is already a widely adopted strategy, with many fund providers offering a variety of similar solutions. For example, here is the iShares Core 60-40 Balance Allocation ETF that is essentially an ETF that invests in various other ETFs to obtain a similar result, but with a much lower fee. These solutions give US dollar investors more choices to look at beyond typical mutual funds like the Capital Group American Balance Fund LUX. Here is a quick comparison chart since 2011, with backfill data for the Capital Group American Balance Fund LUX. We can see the US vehicle has slightly better returns, possibly due to US onshore investment or tax rules. The iShares ETF has lagged behind the Capital Group funds, showing there is still value in going for an active manager even with a widely adopted strategy. We can also see the fund returns fall somewhere in the middle range of SPY and AGG ETFs, representing US equity and US bonds respectively. So this is the returns expectation that investors should have. Things look similar even as we plot the chart since the inception of the Capital Group American Balanced Fund LUX in July 2021. We can also see the broad US bonds market have not done well through the years, which is why many funds, if they are unable to overweight in high-yield bonds, have been allocating to securitized assets to replace some of the US treasuries in their portfolios in order to get better returns. Sing dollar investors, on the other hand, have fewer choices. It is still possible to replicate the strategy with, say, a Mundi Prime USA Fund and JP Morgan US Aggregate Bond Fund in Sing dollar share classes, but the result may not be worth the effort. So for Sing dollar investors that like the 60-40 allocation strategy, it probably makes more sense to go ahead with the Capital Group American Balanced LUX Fund. Another popular US multi-asset fund in the market is the Allianz Income and Growth Fund. The two funds have a very different approach though. Capital Group American Balanced LUX, as we covered, uses a 60% US large cap equity plus 40% US investment grade bonds allocation, while Allianz Income and Growth uses a 1/3 US equity with covered calls plus 1/3 US convertible bonds plus 1/3 US high yield bonds allocation. Interestingly, the two funds have had similar returns in the past 10 years, with Capital Group exhibiting slightly lower volatility and slightly higher overall returns. So this shows that there are many ways to achieve similar results in the investment world. Between the two, I like Capital Group American Balanced LUX better for its higher quality exposures. With that, let's summarize our findings. Capital Group, while lesser known in Singapore, is a large US asset manager with a long heritage since 1931. Many of the products offered here are the replicas of the successful solutions in the US business. The Capital Group American Balanced Fund LUX is one of such products, being an offshore version of the very successful US vehicle that was launched in 1975 and still running strong. The investment objective of the fund is quite straightforward, and is essentially a 60% US equities plus 40% US bonds asset allocation, whereby the fund focuses on high quality exposures and has some flexibility to deviate in terms of allocation limits and exposures. One big issue I have with Capital Group funds is that they do not provide any details on the actual investment process, so investors have no idea how the fund actually works. The fund provides a pretty manageable yield in terms of its distribution share classes, though I would opt for the accumulation share class or at least the lower 5% yield share class so that more capital is retained within the investment for NAV growth. Performance-wise, using the US vehicle as a guidance, the fund appears to be slightly weaker than the benchmark in recent years compared to earlier decades. It would be good if the team can figure out how to boost the returns slightly to be at least on par with the benchmark net of fees. That being said, the active management in the fund appears to work, as the fund has delivered slightly better performance than ETF peers. In conclusion, this looks to be a straightforward and generally stable fund to express a 60% equities, 40% bonds allocation strategy in the US market. Investors should not expect much surprises on both up and downside for this fund. This concludes my absolutely biased comments on the Capital Group American Balanced Fund LUX. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.